Welcome to the FPA podcast. I'm your host, Marney Reid, and today we're talking about a complex topic that orthopedic surgeons should understand before they think about getting it, and that's term life insurance. As we all know, orthopedic surgeons carry enormous financial responsibility, especially as they come out of training. You've got student loans, delayed earning years, possibly young families, and high future income potential. Term life insurance is one way to protect the people who depend on you should anything, God forbid, happen before your retirement years. We're joined today by Lawrence Leary Keller from Physician Financial Services, a well-respected advisor for physicians nationwide. Thanks for helping us unpack this complex topic, Larry.
No problem at all. I'm looking forward to it. And as usual, I'd like to give some good education to your audience.
We appreciate it. We also have Dr. Sara Wallace, hip and knee surgeon in Chicago, Illinois. Thanks for joining us, Sara.
Thanks, Marty. Excited to be here. Hopefully we can learn something together.
Okay, so we're going to start with you, Dr. Wallace. What do you wish you had known about life insurance during your training years or as you began practice?
Honestly, Marty, I knew nothing about life insurance when I was wrapping up my training. At the end of residency, I remember faculty mentioning to me that it's something that I should consider, or potentially I should get a financial advisor. And all of it seemed very abstract and way over my head at the time. I think it would be really useful for young surgeons to understand the various types of life insurance and when are ideal times to consider purchasing life insurance. And is this something that is up to the surgeon to be responsible for, or is this something that you can depend on your employer to help you to decide upon when you do actually sign for your first job?
Such great questions. And if it makes you feel better, Dr. Wallace, I had to pass the Series 65, which does cover lightly all the insurance types. And even studying and passing for a test, it's still so overwhelming. So I'm very grateful that we have a physician champion in Larry on to kind of discuss all of this. So, Larry, share a little bit more about term life insurance and go over what it is, what it is not, what it provides, and when in a surgeon's career would it be a good idea to start thinking about it?
Yeah, so term life insurance is really about as easy as it gets. So surgeons should like this because simplicity is generally a good thing. And really, if you think about it, I'm paying a premium. That's the money that you're paying to the insurance company for a death benefit that will ultimately go to your beneficiary, the person that you choose to receive the funds in the event of your death. It really is very simple in terms of that. We're not building up any kind of a cash value, so it's not a death benefit with any kind of an investment or bank account attached to it. You can almost think of it akin to car insurance. If I get into an accident, I'm going to file a claim and I'm going to need it. Here it's if I pass away prematurely, my family might have some financial issues if they're depending upon my income, and this is solely devised to solve that problem.
Okay, so Sara, any thoughts on this?
Yeah, I guess it makes sense to me. I still feel like I have a lot of confusion about other types of life insurance and when is the ideal time to purchase life insurance.
Yeah, so term life insurance is not an investment. It's pure protection. Its job is solely to replace income for a beneficiary or beneficiaries, because you can have more than one. It's really a way of transferring risk away from you to a third party that we call the insurance company, right? So if one of your goals as a surgeon not only is to excel academically and provide great results or as close to the ideal result as possible to your patients, you're really earning income. And this is a way to replace your income to your family or beneficiary in the event of your death, much like a disability insurance policy will replace an income to you in the event you're too sick or hurt to continue to work in the capacity of an orthopedic surgeon. Now, the cost for term life insurance, relatively speaking, is very low. At young ages, we know that the likelihood of passing away is low. Does it happen? Yes. Does it happen all the time? No. And the larger our population, the easier, short of acts of God or something like that, we really can predict these results. And that's kind of how we price term life insurance. So it's a pretty predictable, low cost tool that gives surgeons peace of mind as they build their career and they build their families and they get into practices. Maybe they're buying into a practice. Potentially they're buying into a surgery center. And even if you don't necessarily have beneficiary in terms of family, if you're taking out a loan to buy into the practice or the surgery center, you might very well find that the bank is requiring that you have life insurance that you're going to assign to them. And it might say something like, well, Marnie, we're going to give you $500,000 that you can go buy into the surgery center or the practice. And we know if you're working, everything is good. We're going to get paid back. But what happens if you pass away? How are we going to get our money back? So really what we're doing is we're saying, okay, whatever amount, or the technical term is as interest may appear, the liability to the bank, that's going to go to the bank first and foremost. And then the balance is actually going to go to your typical beneficiary that you have noted in the policy.
Okay,
What
so that makes sense of what it is, but I mean, does it expire? If it expires, what happens? Can you tap into it if you aren't, working or if you change jobs? Like, what does it not function as?
Yeah, so it really doesn't function, as any type of cash value insurance. It doesn't have any kind of investment component. It is death benefit only.
Dr. Wallace, knowing now that this is, you have to expire to get it, that, it even expires upon, certain terms and everything where it sounds like you're kind of locked in and need to constantly contribute to it. Based on what you know of orthopedic surgeons and the various different examples of them, coming out in training or whatnot, when do you feel like surgeons need to really start looking into this for their families?
I remember thinking about it for the first time when my husband and I were about to get married. And I don't know if that's the appropriate time point, but it's when we first started thinking about it. I remember reevaluating life insurance when we first had kids. Again, I don't know if there are other time points when surgeons should be considering life insurance. I remember that some of my colleagues who were still living the bachelor lifestyle when they finished their residency program were not considering life insurance. And to me, that sort of made sense. It just seemed really abstract at that point in time. What would be the role of purchasing life insurance if you really didn't have any dependents at that time? Is that a reasonable way to think about this, Larry?
Yeah, I think that's 100% way to think about it. I mean, someone might be single, living the bachelor lifestyle, and why would they think about it? Probably the one that jumps to mind most is if someone has medical school loans and they were co-signed, by some family member, and God forbid that person passes away, and now that co-signer has to take on that debt. So that would be one reason. The second reason would really be family history. So our bachelor is running around having a great time. That's all good. But they do have family history. And let's say they've got, brother and a sister. Both of them have type 1 diabetes. They don't. They're in great shape, but they don't know that that's not going to ultimately happen to them. So they can buy a term life insurance policy to protect what's known as their future insurability, where they can lock into a premium that is low when they're young and healthy without any type of personal medical history. Those are probably the two biggest times that I'll see someone without dependents actually buy term life insurance
That's
or consider buying
really
it.
that's really interesting in terms of, getting locking in the ability to insure yourself for later on, because I didn't even think about that, it might be more expensive. Larry, I want to go back real quick. You brought up a really interesting point, and we see this a lot, especially for physicians that get out and then they want to, buy a house, or they do get a loan. This is more private practice for buying into an ancillary service or even partnership. Let me ask you this. So a surgeon goes out, they get a loan for buying into, partnership or whatever. The bank makes them get a life insurance policy where they're the beneficiary. Can you get more than one so that your family is also covered? Because how horrible would that be if you're the surviving spouse with two kids, a lot of, medical debt that you probably co-signed on, right? Because most, I think, significant others are working while their partner is in residency and fellowship. And then your partner passes. Not only are you racked with grief, you think that you're covered on the home you just bought, and then you find out the bank owns the loan for something else. So how can a physician protect their loved ones in that instance?
Yeah, so believe it or not, you'd actually can do it with one policy. Like you would not necessarily make a bank your direct beneficiary. And if you think about it, it makes sense. Let's say that my mortgage or my buy into the surgery center is 500,000. I've been paying this off. I now owe the bank 300,000 and they're the beneficiary on my policy for 500,000. The bank basically gets a windfall. So what we would do is what's known as a collateral assignment. So we would buy the policy with my beneficiary, let's say my spouse, as the beneficiary for that full amount. After the policy is approved and effective, we would collaterally assign, as interest may appear, to the bank. So whatever the bank is owed at the time of death, they get that first, and then the balance actually goes to the beneficiary of the policy. So we're not constantly updating beneficiaries, we're not constantly updating the amounts. And then once the loan is fully paid off, that physician would want to go to that bank and have them sign a release of the collateral assignment form. Now your beneficiary is 100% your beneficiary, and the bank's interest is no longer recorded on that policy.
So let me ask you this, because where I'm coming from this is I grew up with a very paranoid attorney father, right, that wanted to make sure everything was protected and covered. Let's say that I'm a physician. Let's say I have two kids, a loan on my house, a partner that right now doesn't work. Do I want to pay a pretty good chunk into that, knowing that the bank gets it first? And then once I pay off the bank loan, do I need to remember and then scale down on the payments that I'm making?
Well, if you do the collateral assignment, you don't necessarily have to do that. That will happen automatically. And you'd really find that in a surgical center setting or a practice buy-in, you wouldn't do this for your mortgage. Your mortgage would be my beneficiary is my spouse. They're going to receive the proceeds of the insurance policy. They can decide that they want to pay the house off if there's enough death benefit for that. They might decide they're going to take the death benefit and they're going to use that for family income and they're going to make the mortgage payments as they normally would. So I don't think you really have to do any kind of direct beneficiary, with a bank. You would do the collateral assignment, not for a mortgage, really for a practice buy-in, most likely for a surgical center. Other than that, you could do it with one policy. By the same token, you could have multiple policies like you mentioned. So maybe my practice buy-in is a 5-year loan, and I don't really want to commingle my personal life insurance for my family with the insurance that I'm buying as a result of one of my business transactions. So maybe I'll have a 30-year term life insurance policy, so fixed rate for 30 years for my family, and I'll have a 10-year level premium term life insurance policy that is collaterally assigned to cover my practice buy-in or my surgical center buy-in. And again, that balance, if it's collaterally assigned, whatever I no longer owe would go to my family at that point.
That makes sense. Dr. Wallace, I almost feel like I should try to send some of these podcasts out to academic program directors at the start of every other year or something like that so that they can share this, because I feel like there's so much in this that I would want my residents and fellows to just know, and knowing that they're paying attention to different things at different parts of their lives. What are your thoughts on something like that?
Absolutely. I don't think that there are many resources at all for this type of information. And unless you have a spouse or family member that is connected with someone like Larry or in financial advising, it's really difficult to know who you can trust. And so, yeah, Marnie, I think that's a great idea.
Larry, walk us through a couple of different examples of, the how, what best practices of term life insurance. Let's say scenario one is immediately before or after starting, practice, so that kind of finite time after fellowship. Or if you're a, chief resident and you have a situation where you're not going to do a fellowship because you're doing general practitioner or general orthopedics, or after a major life event, kind of walk us through these scenarios.
Yeah, so let's go first major life event is you're married or you're getting married and you plan on becoming pregnant soon after. Well, for our females that are planning to become pregnant, one big thing that can really wreak havoc on life insurance rates happens to be gestational diabetes. So I tell all of my female surgeons before you're even thinking about becoming pregnant, you should buy your term life insurance to lock that in while you're still young, you're still healthy, you're not currently pregnant. Because once you are flagged as gestational diabetic, your premium rate is likely going to come close to doubling. And until you're out of childbearing years, it's going to stay that way. Now, if I'm just married, I don't even plan on having kids for a couple of years. I may or may not be buying a house, after the first couple of years of practicing. I want to make sure that this practice is where I'm going to stay and the geographic location is actually working for me. I don't have to go out and buy a massive amount of life insurance. I could say, I'm going to go out and I'm going to buy $1 million or $2 million of 30-year level premium term life insurance. So let's say I'm 35 years old. I buy this policy. I now have a fixed rate until I'm the age of 65 for 30 years. Now I start to have kids and I plan on having more than one child. Well, I could go out and I can buy more 30-year term life insurance, but now if I'm 40 or 45, do I really need that to take me to that type of age? I've been practicing for a long period of time. I'm paying down debt. I'm accumulating assets. My net worth is growing. Really, short of estate planning, my need for life insurance is actually declining. I'm getting closer to the point where I can self-insure. So there's a concept you might have heard of. It's called laddering your term life insurance. And really, all that we mean by that is you're buying different death benefit amounts. They could be the same with different durations of time. So maybe I have a $2 million 30-year term policy. That's going to take me to the age of 65. Now I plan on having additional children. I could say, Marnie, I'm going to get another 3 million, but I only need this for 20 years. So now if something happens, my first policy for 2 million is going to pay if it's within that 30-year period. That $3 million policy that I'm buying, if it's within that 20-year period, that's also going to pay. There's $5 million. Once I hit the 30-year term on the original policy, that $2 million is going to go away along with the premium that I've been paying for that. And then I'm going to have whatever remains on that $3 million 20-year term policy. I'll pay that premium. And at the end of 20 years, that too is going to go away. So personally, if I'm doing my financial planning correctly and I'm accumulating wealth and I'm paying down debt, I think the laddering approach can make an awful lot of sense. It does save you a good amount of money up front doing it this way.
I think it makes sense.
So
Yeah, that sounds
really,
like a strategic way to go about it.
yeah, it really kind of takes your financial plan and merges your insurance plan. So they're kind of going hand in hand. I
There,
think that's really important. Now, ideally, you want to get your children out of college, maybe out of graduate school. And when you're determining the time frame, you're really looking at, well, what are the ages of my children? if I have them? If I have one, do I plan on having more? And that's a starting point as to how you want to gauge your duration. Do I plan on buying a second home? Do I plan on refinancing my mortgage? What happens if I'm in an academic center and my goal is to, let's say, go for public service loan forgiveness? Once I have that, I want to go into private practice. Now I'm going to be an associate. I'm ultimately going to be a partner. And at that point, I might be buying into a practice or a surgery center, right? So these are all the things that you want to take into consideration as you're determining the duration for your insurance. And a good rule of thumb for death benefit amount is 7 to 10 times gross income. That's a very common rule of thumb used among financial professionals.
Larry, you and I had an interesting discussion as we prepped for this podcast. And obviously, we want to make sure that we know that there's good and bad, out there. Can you tell me, because you said quite specifically that you intentionally just do insurance and you don't also do financial planning. Can you talk to us about people who are both financial planners and sell insurance products? And I think I remember that there are legal requirements to disclose to your client the commission that you make off of the insurance products if you are also the financial planner, because I think that's very important for our audience to understand.
Yeah, and there's really three different ways in which financial planners or insurance agents get paid. And these are important to know. And it doesn't necessarily mean that one is better than any of the other. I think what's really important is that you understand how the financial professional is being compensated for their time and for their efforts. So the first one, this is me, and I'll be the first one to tell you, we get a terrible reputation, commission only. So we are product salespeople, term life insurance, disability insurance. We sell a product, a commission is paid by the insurance company to that financial professional. So some people are going to say, well, this person's not going to give me anything other than advice to go buy a product because if I don't buy anything, they're not compensated. Now, that is true, but if you've been in the profession for a long period of time and you've really worked hard to build up your reputation, you're not going to go out, I would hope, and try to sell products to people that don't need the products solely to earn a commission. The second one is what's known as fee-based. And this is exactly what you described. So I could be a certified financial planner professional, and I could also be licensed to sell insurance and investments. Well, if I'm acting in the capacity of a certified financial planner, my belief is I should be charging you a fee for a financial plan. And if you want to implement the financial plan, that's great. If you don't want to implement the financial plan, that's okay too. But personally, if I'm charging you a fee for the financial plan, and then I'm turning around and I'm selling you financial products and being compensated as well, this is very much in the medical world like the Stark Law. You really have to pick how you're going to be compensated. I personally believe you're either selling a product and being paid for selling financial products, or you're charging for financial advice. You really cannot effectively do both of those things. In fact, if you're a fee-only financial advisor, and then at the same time you're selling products, you're right. You actually have to say, when I'm working as a fee-only advisor, I have a fiduciary duty. I need to disclose my conflicts to you. You have to understand where I'm coming from. But once I put on my other hat and I'm acting as an insurance agent, that fiduciary responsibility is no longer there. And now I'm acting as an insurance agent. And what we have there is called a suitability standard. So I don't have to give you an ideal result. I just have to give you a result. And if it's something that I can justify to a regulator, I put you in a better position than you were before, so be it. And then the third one I think makes a lot of sense is a fee-only certified financial planner where you're paying for a financial plan. And that's it. If you take the advice, you paid. If you don't take the advice, you still paid. I'm always shocked by the people that pay for a financial plan. They get the advice, and then they don't actually implement the advice. But that's okay. You're paying for a service. It's kind of like an Uber driver. I want to go from point A to point B. I'm willing to pay. Tell me how to get there. If I want to make a stop, I'll let you know. So personally, for me, I try to keep my financial professionals that sell products on one side of the equation and the ones that actually do planning on the other side of the equation. And very often you might find someone like me that is a certified financial planner professional working in conjunction as the insurance agent with another certified financial planner professional that is working solely on the planning side of things. Does that make sense?
That does. Well, we're wrapping up part one. Stay tuned for Larry and I to stay on and unpack a little bit more about the basics to really get into it, especially for those of you out there that really want to feel like you have a grip on this before you go talk to a different professional or maybe call Larry. Dr. Wallace, would love to get your take. You came into it and you said, you know, very little. You do think it's something that people and surgeons especially should be educated on at all different stages. Now that we've had this discussion, if you are, I'm going to ask this in a two-part question. If you're advising your residents and fellows, what would you say that they need to look into for something like this? And then as you're advising your colleagues, right? So tenured physicians in practice, what would you also advise them if that advice would be different?
I think it's important to understand the different types of life insurance and what your employer is providing versus what you might want to purchase on your own. I think it's also probably good advice to talk with your partner, if you have one, about what your long-term goals are and whether it's most appropriate to look at something, to look at a plan that's a 20-year plan or a 30-year plan, as Larry had mentioned, and what your family and life plan looked like over the next few decades, which I think is difficult, but it's certainly worth taking a pause and having that conversation as you're embarking upon your early career. Something that I would like to hear more about from Larry in the future, and I think he touched on this, but really, do things change if you are in a two-physician household, or maybe it's just a household where you are both in high income type careers? Does your plan change? And is it okay to potentially lean much more heavily on one partner's life insurance versus another? And what does that look like based on the employment status and income status of both partners?
So yeah, what you find is in tool physician households, I don't necessarily know that things change dramatically, other than maybe the duration of coverage might be a little bit shorter. You know, if one of the physicians in the couple is earning substantially more than the other, I'd probably insure that higher income earner to a larger extent, and I would insure the lower income earner to a lesser extent. Believe it or not, even if you have a non-working spouse, that often gets overlooked. And I think something like $1 million, 20-year level premium term on a non-working spouse makes a lot of sense, because if we have our surgeon and their non-working spouse is at home with the kids, unfortunately, if the non-working spouse passes away, they're no longer going to be able to work anything close to the hours that they did prior to their stay-at-home spouse's death. So that becomes really important as well. So every situation is different. I would say the dual physician couple probably has a bigger impact on what you do on the disability insurance side than it does on the life insurance side, especially if the two incomes are being used for lifestyle or potentially being used for savings to become financially independent and retire early.
Thanks, Larry. That's really helpful.
Well, thank you both, and I hope our listeners learned a lot. We are going to wrap up part one, but stay tuned for part two, where Larry and I continue to unpack some of the basics and some other nuances that you really want to know before you look into this. Thank you both for joining.
Thank you for having us. Greatly appreciated.
Thank you, Marney.
Thank you both for such great advice and insight and thoughts. For our audience listening in, we hope you got some great information from here and you have a better understanding of how term life insurance works should you want to look into that. If you'd like to reach out to Larry with any questions, please email him at lkeller, L-K-E-L-L-E-R, at physicianfinancialservices.com. Thanks for joining us, and we'll see you on the next episode of the FPA Podcast.
This podcast is intended for general public use and is for informational and educational purposes only. The Foundation for Physician Advancement podcast is not affiliated with or endorsed by Park Avenue Securities, Guardian, or Physician Financial Services, and opinions stated are their own. Lawrence B. Keller is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 777 3rd Avenue, Suite 1703, New York, NY 100172125418800. Securities products and advisory services are offered through PAS, member FINRA SIPC. Financial representative, the Guardian Life Insurance Company of America, Guardian, New York, NY. PAS is a wholly owned subsidiary of Guardian, AR Insurance License number 1057229, CA Insurance License number 0C37340. Physician Financial Services is not an affiliate or subsidiary of PAS or Guardian. 886-0615.1 Expector, April 28th.